News Talk 94.5 WPTI. You're listening to the Wealth Guardians with Doug Ray, helping you retire the job and keep the paycheck. I'm your host, Doug Ray, and with me is Brice Payne. Today, since we are knee-deep in playoff season, we're going to be talking about don't fumble your retirement in the financial red zone. Good morning, Brice.
Good morning, Doug, and happy football playoff season to you. Your team made it. Congratulations.
Big game tonight.
Big game. Is it tonight?
It's tonight. Yep.
All right. Mm-hmm. All right. Looking forward to it.
Got the 49ers at Lambeau.
All right. Very good. You know, of course, my Broncos have already gotten rid of their coach, and they're looking for a new one, just like we do about every 2 years or so, just like the Raiders used to do every season years ago.
A lot of turnover this year.
A lot of turnover. All right, but I'm looking forward to it. I look forward to the blood and guts spilling out on the field there. Speaking of competition and football and all that, Doug, let's give a tip of our hat to those competitive warriors out there who put on the uniform every year, every day, year in and year out for the good old Stars and Stripes. Folks, we want to thank you here at the Wealth Guardians for either being a first responder or putting on that uniform. We know it's not easy. You're making a lot of sacrifices out there, and a lot of time those sacrifices go unappreciated. We want you to know that Doug and I are thinking about you, and the Wealth Guardians are thinking about you, and thank you for your sacrifice. All right, Doug, let's get into things. Don't fumble your retirement in the financial red zone. You know me. I always love it when we can take financial planning back to a sports metaphor.
Especially football.
Especially football. But, you know, baseball sometimes, hockey sometimes. But, yeah, football is my main one. So what do we mean by that, Doug? Don't fumble your retirement in the financial red zone. I love the sound of it.
Well, you know, in the football analogy, the red zone is the 20-yard line. When the offense gets down there, that's the red zone. Obviously, it's a critical area where you need to come away with some kind of a score. Well, for us as retirement planners, the financial red zone can be anywhere between about 10 years before retiring and especially that critical 5 to 10 years after retirement. Because in this area, if you make a significant mistake, then that's going to set up your retirement for probably not a very good outcome. And if you are 10 years prior to retirement, especially if you're getting down to 5 years prior to retirement, you really need to start putting down pencil and paper your retirement plans. I know you've been putting money in your 401k and you've been diligent about that, and maybe you have a pension if you're lucky in this day and age, but it needs to be written and on paper to give you a guideline. Don't you think, Brice?
Oh, absolutely. You don't go into retirement. It's something generally you only do one time in your life, and you've generally been preparing for that for about 40 years. So you don't generally want to go into that without a game plan written down. When going back to the metaphor, coaches have a whole different set of plays for in the red zone than they do for the other 80 yards of the field. Things get a lot more congested down there because your safeties, your free safeties, aren't running 30 yards back. They're in tight. Your wide receivers have to run a lot tighter routes. There's a lot more chance for interception because everything on the field is more congested. There's a lot more room for error, and it's critical. You worked 80 yards or so to get down to that point of the field, to get to that part of the game. You don't want to mess up at that stage. And you don't want to do the same thing in retirement. If you've been saving for 40 years or so, the last thing you want to do is to simply have not dotted an I or crossed a T on that proverbial financial plan and then see way too much go sideways because of something you just didn't anticipate, like unplanned for healthcare costs, higher than normal inflation rate, a bigger dip in the economy than what would have been expected. A lot of things can go wrong, and you want to make sure that you've got that right?
Absolutely.
Absolutely. All right. If you're just tuning in, you're listening to the Wealth Guardians, and we're talking about not fumbling your retirement in the financial red zone. And Doug, we've been talking about the mistakes that one can make in retirement because they didn't plan for the last few years of retirement when they're close to retirement. And speaking of that, we've got a seminar coming up, and we're titling it Retirement Success in Turbulent Times, which ties in perfectly to this.
Yeah, folks, I think you've probably been aware of the market conditions this month in January, and, the Overall markets are down between 4 and 8%. What's interesting about that is about 70% of all stocks are down 20%, which means you've got a handful of the big names that are keeping things afloat. On this show over the past year, I've been telling you I expect 2022 to be a relatively rough year.
It's not disappointing so far.
It is not disappointing. We have been going down the whole month of January. Looking at my charts, it looks like the last week we might get a bounce to do a correction back to correct the down. Every time you go down, you get some sort of a corrective wave going back up, and that correction could be anywhere between a third, a half, or 2/3 of what you came down. So if we're down 8%, then I would expect maybe a 4 to a 6% bounce back up. Then you have to watch very closely to see what follows, because after that, if we truly are going into a significant bear market, then that next wave down could be significantly down. If you remember back to 2008, we watched the Dow go down 1,000 plus points a day. And I'm not saying that's going to happen again, but the possibility is there. So, look, retirement success in turbulent times. Perfect timing for this workshop. It is Thursday, February the 10th, Tuesday, February the 15th, 6:30 p.m. in the Broy Hill. Give us a call at 336-391-3409. Get registered. We're going to cover topics about how to protect your retirement if, in fact, we are going into a downturn. We're going to talk about how do you score the risk of your portfolio. Brice and I will do that for you, and we'll do that free of charge.
And seating is limited, so you do have to register. So, again, please give us a call, 336-391-3409. You can also register at our website, thewealthguardians.com. It's not filled up yet, but it will in all likelihood be by the time we get close to that date, so don't delay.
I think this one, given the topic, I think this one's going to fill up.
I agree as well. I do think it will. Very good. So, Doug, our next topic here, while sticking in the don't fumble your retirement in the financial red zone, is why do people need to pay attention once they get to this point in life? And there's no shortage, Doug, of people that we meet with. We stress test, when we do a financial plan for somebody, we stress test both their current portfolio, and if we make any recommendations, we stress test our recommendations for a 2000 to 2009 market period. And why? Because there were a number of different corrections that happened at that time period, or at least relevant turbulent times. You had the dot-com bust of 2000, you had 9/11, 2002, you had the financial crisis in 2008. And what we'll get sometimes is somebody will be a little curious why we're stress testing. Is that a little unfair to stress test my portfolio during that particular time period? They say, I went through that time period, I lost 40% or so, and it didn't devastate me. Well, the key is that you weren't a few years away from retirement back then.
Yeah, how many times have we heard that? I mean, they said, we knew we were 10, 15 years away from retirement, so it didn't really bother us. But now, you may be 4 years away or 5 years away. You cannot afford a 50% loss. It
takes time to recover. And again, we do the math here. If you have a 50% loss in your portfolio, Doug, you need 100% return to get back to where you were. Well, if you're planning on retiring in, say, 2 years, and your portfolio drops 50% or even 40%, that's going to take 3-4 years to recover, assuming you're still making contributions into the account too. Well, if you're going to retire and you're no longer daily cost averaging into your account, and then you're taking distributions from your account, good luck on trying to get that 70% or 100% return back. It's not going to happen.
Yeah, folks, don't let March of 20 just kind of whitewash things. I mean, that was a very, very quick recovery. It took 4 years to get back to the 07 highs. And remember this, it took 25 years to get back to the 1929 high when we went into the Great Depression. Look, not saying that's happening, but you got to have an idea of what kind of timing it takes to recover losses.
And if you don't have time to go to our seminar, you can certainly sit down with us. There's no cost or obligation for meeting with us. We'll see what help as fiduciaries we can provide you on planning for your retirement. All you got to do is pick up the phone, 336-391-3409. That number again is 336-391-3409. We're about to jump into the trivia question to see if we can stump Doug here. But before I do that, I do want to mention again, like we mentioned last week, January is National Blood Donor Month. And if you have the inclination and you've got the ability, I would highly encourage you to go to redcross.org or give the Red Cross a call, 1-800-733-2767, and you can donate blood. You can do that about every 8 weeks or so, but they'll give you the specifics on it. But for the first time ever, the Red Cross has issued a national emergency for blood donation and platelet donation, so they desperately need some help with that. So thank you very much for doing what you can on that. Everyone benefits from it. Now, let's go to our trivia question.
It's time for today's trivia question.
All right, Doug. In honor of Blood Donation Month, very simple question here. How many human blood types are there?
Oh, boy. I think I used to know the answer to that.
We will be back right after this. This is Brice Payne. With me is Doug Ray. The show is The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. News Talk 94.5 WPTI. You're listening to The Wealth Guardians with Doug Ray, helping you retire the job and keep the paycheck. I'm Brice Payne along with Doug Ray. In this segment, we're talking about 5 signs you're in good financial health. If you are out there and you're 5 to 7 years from retirement and you want to confirm you're making the best decisions for retirement, we offer a no-cost, no-obligation second review so you can learn to retire the job, yet keep the paycheck. All you got to do is pick up the phone, give us a call. It's that easy. 336-391-3409. 336-391-3409. We are also out there on that interweb thing at thewealthguardians.com. Look us up. We'd love to hear from you. We'd love to see what Doug and I can do to help you prepare for retirement. Now, before the break, we asked a trivia question, and it's time to see if we stumped Doug.
It's time to get Doug's best guess on today's trivia question.
And Doug, the trivia question we asked was in honor of Blood Donation Month, January. How many human blood types are there? A very simple question. I'm even going to make it easier on you. I'm going to allow you 2 different answers.
Oh, gosh, that's great. You're forcing me to go back to high school biology.
Oh, boy.
And since I lasted a whole half a semester in pre-med at East Carolina, let's see. Biology got me there, too. 5?
Oh, not quite. You got in between the 2 answers that we were looking for. So when I did my research on this, there's 2 answers. There's either 4 main groups or a total of 8 total blood groups. So the 4 main groups are A, B, AB, and O. But each of those have a positive and a negative. So you're either A positive, A negative, B positive, B negative. So there's either 4 or 8, depending on how you want to answer. 5 just kind of cut it in the middle. So I'm going to say that this week we stumped Doug.
You got me good.
Yep, biology hit you again, doesn't it?
It did.
Well, thanks for playing at least.
I got D's and glad to get them.
That's 2 weeks in a row. So that's January is coming around just as strongly for Doug on the trivia question as the market is for us. So.
Oh, boy.
Now, like I said, we're talking about in this segment 5 signs you're in good financial health. And let's jump right into it, Doug. If retirement is on your mind, then I'm urging you to listen up today's show for a 5-part checklist. It's going to help you measure if you're in good financial health and setting yourself up for retirement success. Everyone wants to do that, and I know you're out there listening. You want to set yourself up for good financial success in retirement as well. The first one, you spend less than you make, Doug.
Well, when you say it that way, that just sounds, isn't that reasonable? It is. But, Brice, how many people do we sit down with that have no idea how much they spend.
That's exactly right. You got to have a budget, so you got to know what you're spending. You got to know what you make. Most people know that. They know how much they make. I think it's kind of a fear thing or kind of shielding your eyes, putting your head in the sand. Most people who come into us don't know how much they spend. I don't know if I say most, but a lot of people who sit with us don't know how much they spend. And you got to, don't just look at the money coming into your accounts. You got to know the money coming out of your accounts. But the reason this is important, Doug, in retirement, Social Security is one of the main legs of your retirement stool. That's designed to replace what percentage of your retirement income, of your earned income in retirement?
So for most of us, it's not going to replace, but about half or so.
Yeah, around 40% is all it's designed to replace.
Yeah, right.
So now just do the math. If you are putting away 50 to 60% of your earnings while you're working, and that's going into some kind of savings account or investment account, then the math would tell you that you're only spending around half or 40% of what you're making. So you're spending less than you make. That's good. That's going to make retirement an easy adjustment for you. But if you're spending about 90% of what you make while you're working, then you better have some really good Social Security, you better have a pension, and you better have had some inheritance or something to supplement Social Security.
You know, I find it somewhat humorous. One of the bigger pushbacks we get when we do the planning for people is most people detest making a budget.
They do.
And we make them.
We do.
We make them do
it's homework.
That. Because, folks, that number, what you spend, what you live on, is one of the most important numbers we crank into all the planning that we do for you. Because this is your lifestyle. And our goal is to get you through to and through retirement, maintaining your lifestyle and not running out of money.
It's not just about keeping the electricity on and food in the fridge. It's about enjoying retirement. That's what at least we're trying to accomplish for you. Mm-hmm. Yeah, so you do have to understand that you spend less than you make. You do have to understand what you're making, what you're going to be making in retirement. We can help you figure that out. We've got the software to do that. But you got to come to us with a budget. And if, again, here the topic is 5 signs you're in good financial health. If you are spending less than you make, then that's one sign that leads us in a good physical checkup there, a financial checkup. Second one is you understand the future tax implications of your savings. That can get complicated, Doug.
It sure can. You know, while you're working, while you're accumulating your wealth, I mean, you obviously are dealing with income taxes, real estate taxes, sales taxes.
Long-term capital gains, maybe short-term capital gains.
Exactly. But, you know, when you retire, you know, you still got the long-term capital gains, short-term capital gains, you still got the real estate taxes. But now you may have taxes on your Social Security,
which is taxed in a whole different way than what you're used to.
Completely different way. You may have taxes on your Medicare Parts A and B.
There's a whole bunch of different tiers there for that.
D's, absolutely. And all that's income related. And there are ways to structure your income distributions to lessen or even eliminate some of those extra taxes you don't know about. And that, again, is part of the planning that we do for you here at the Wealth Guardians.
Yeah, and that can be as simple as making sure, I mean, it's not simple, but there are some simple steps to do it, making sure that you've got the right types of accounts in retirement. Almost anybody who comes to us has a healthy amount of IRA or 401k money, pre-tax money. But you want to prepare for all the different tax brackets that might be out there. And one of the best ways to do that is start amping up your Roth contributions or your after-tax contributions so that when you do retire, if you want to skip going up to the next tax bracket accidentally, you can pull from your Roth accounts. There's going to be some good years to do IRA to Roth conversions. There's going to be some bad years to do that. We can help you with our software figure out what years are the key years to move money from your IRA accounts to your Roth accounts so that you are better prepared for whatever tax laws come down the pipeline years later.
Let me give you an example. We were working with a couple just this week, and they have the standard deduction, just like most of retirees do. They don't have enough to itemize yet, and they were making charitable contributions. Well, their charitable contributions were like $5,000, and they were just writing a check off to whomever their charities were.
Yep.
And they're in a situation where they're having to take required minimum distributions from their IRAs. So when you take your required minimum distribution, you're going to pay tax on that. So what they were doing is they were making a charitable contribution, but since they couldn't itemize, it was doing them absolutely no good on their 1040. So here's what they could do, and this is what we suggested. Instead of taking the RMD that they didn't spend anyway, have the IRA custodian send it directly to the charities. Because if you can bypass that RMD hitting your 1040, you're not paying tax on it. Yet you're accomplishing taking your RMD. The way they're doing it now, they're writing a check for $5,000, but they got to pay tax on it, which means they're probably spending $1,000 in taxes to give away $5,000.
Yep.
Just have their IRAs give the $5,000 to the charity. Keep Uncle Sam out of the dadgum equation.
There you go. It's as simple as that. And a lot of people are not aware of that because it's not relevant until you reach 72 years old. So why would you have been aware of it? If you're just tuning in, you're listening to the Wealth Guardians, and we're talking about 5 signs you're in good financial health. Now, Doug, this is a great point for us to mention that we've got a seminar coming up called The Retirement Success in Turbulent Times, and that's coming up February 10th. That's a Thursday. And February 15th, that's a Tuesday at 6:30 p.m. Why is this such an important topic for somebody to want to come in and sit down with us and listen to the seminar?
It's a different workshop than we've done before. Yes, we're going to do the taxes one coming up. We're going to do Social Security again. But this one's important because, all last year I've been warning that I thought 22 was going to be a very difficult market year. January has started to prove that to us. So we designed this workshop to enlighten you as to what you can do to avoid a really negative, bad market. We're going to talk about things like how to judge the risk you have in your portfolio. We're going to talk about how we help you figure out the amount of fees you have in your portfolio. What amazes me is people will come in and they'll sit down with us and they'll say, we're very conservative and we've got a conservative portfolio. And when we do the analysis, it turns out that their risk tolerance is conservative, but their portfolio is nowhere near.
Very common. Far over 70% of the time is that the outcome that we have with people we're sitting down with. Their risk tolerance is on a scale 1 to 100, around a 30, between a 30 and a 40, which is where it should be at that stage of life. Yet the risk on their portfolio, when we run it through the analysis, is somewhere up in the 60s. And those two things are not in sync, and that is way too much risk for somebody who's only a few years away from retirement.
All right, folks. So Retirement Success in Turbulent Times. We'll be presenting February the 10th, which is a Thursday, and February the 15th, which is a Tuesday at 6:30 in the Broyhill. Give us a call to register, 336-391-3409. I really think this one's going to fill up. I mean, if you've been paying attention to January and what the market's doing, I think people, at least people that come in and talking to us now, are a little bit uneasy. So get registered, come in, and find out what you might be able to do to protect your portfolios.
And you do have to register. So again, 336-391-3409. You can also register on our website, thewealthguardians.com. Doug, we've got time for one more here.
Okay.
And the 5 signs that you're in good financial health. Number 4, you have a retirement income plan. That's as big as it gets.
It
right
is.
There.
Most people, if they know what the roadmap looks like going into retirement, they're going to have a very successful retirement. If you're working one day, you retire the next, and you have no clue, you're in trouble.
It's that simple. You don't do something. We use this analogy all the time. Joy, one of our office managers, went down to Disneyland with her family. She created this huge, massive itinerary of what they're going to do hour by hour.
That was amazing.
Day by day. And that was essential for them to enjoy their 3 or 4 days that they spent at Disneyland. Spending 3 decades or so in retirement, trying to do that without going in with a financial plan. That's crazy. It's plain and simple. You wouldn't start a health regimen without at least consulting some kind of professional on what you should be eating and what type of exercise you should be doing. We want to get you in good fiscal shape as well, good financial shape as well. So let us help you out. 336-391-3409. We'd love to sit down with you and see how we can help you. Doug, that's all the time we got for today. Thank you for joining us, And good luck tonight with your Green Bay Packers. This is Brice Payne. With me is Doug Ray. The show is The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI.